Good afternoon, everybody. It's a pleasure to have a very good friend of our real estate program, Spencer Haber. He is the CEO and chairman of H2 Capital Partners and soon to be the chairman of the Zell Lurie Centers Advisory Board. Spencer, welcome.
Thanks,
We
Chip.
really appreciate
Thanks
you
for
taking
having
the
me.
time. It's our pleasure. Let me turn us back to post-crisis regulation and how that's going to change the nature of the real estate credit investment business, the lending business. I think importantly, a number of viewers will be investors who want to borrow. How has that landscape changed, and what should borrowers be expecting to see in terms of the players going forward?
It's interesting. Just before our talk here, I brought some colleagues down to Philadelphia, and we were visiting with a prospective borrower. And the prospective borrower is a very well-regarded private investment manager for real estate funds. And we sat with their entire investment team, and we told them a little bit about our credit business, but we also listened to them. We asked them, what are you getting or not getting from your traditional lenders? And notwithstanding the availability of credit in commercial real estate that's come back into the market primarily in the last 2 years, 2.5 years, there are still some notable gaps, I think, in them credit markets from a borrower's perspective, and it's something that we heard just a few hours ago from this investment manager that we met with. The cocktail of re-regulation that the banking system has seen in the last 4 or 5 years, so Dodd-Frank, Volcker, risk retention, so skin in the game. What is happening with capital adequacy in terms of Basel II, Basel III, and just generally the deleveraging of some of the financial system and the banks in particular, more so the banks and the insurance companies, I think we've seen has a couple of impacts. One, the capacity for the banks to originate and hold on balance sheet risk that looks a little different than what is very commodity-like, generic, almost securitizable risk. That's clearly less than it was pre-crisis. The bank's ability to hold larger loans on their balance sheet. So this infatuation that some of the rating agencies sometimes have with granularity. So they'd rather have 20 $10 million loans than one $200 million loan. We could talk about the merits or demerits of that. We're seeing that in the bank world, so a little bit more of a preference for smaller loans. There are a couple of banks that are the exception to that rule. The ability to move quickly, the ability to be flexible, the ability to deal with the curveballs. Those things that I think the banks did more of pre-crisis because there was just a mode of asset gathering, that we still haven't seen on the bank balance sheets. I think when there's a relatively down the middle, relatively long cycle process for obtaining a loan at a relatively low leverage that doesn't have a whole lot of twists and turns, there is a bank balance sheet bid for that risk, and that bid can be aggressive on pricing. But we haven't seen the banks really step out of that relatively narrow box in the last couple of years. I'd say the same thing is true for the insurance companies. So order of magnitude, the insurance companies as a group cap out at $50 or $60 billion of volume a year. And to give you what the denominator looks like, it's an asset class that has to roll in the U.S. $200 to $300 billion a year. So I think the banks have been more aggressive in the last couple of years, but are still somewhat constrained because of that re-regulatory environment in terms of the kinds of things that they can do relative to pre-crisis. Construction lending is another one. While there is some construction debt available, and I'm sure these numbers, I'll get the numbers wrong, you guys will always get the numbers right, but I think pre-crisis rough numbers were maybe $700 billion-ish of outstanding construction debt from the banks. That number is a fraction of what it was pre-crisis, and generally you've seen, except certain markets and certain property types, a lack of new supply across lots of markets in the last 5 or 6 years. There's some apartment markets that are clearly the exception. There are a couple of office markets that may be the exception. But by and large, you have not seen the banks get back into construction lending, and you have seen, and this is perhaps where your question goes, the emergence of private capital as an alternative to traditional financial institutions, the non-bank banks of the world. And that opportunity for pension fund money, for foundation money, for sovereign fund capital to really play a role in traditional finance, not just opportunistic finance or distress, but really a traditional finance function is something you've seen in commercial real estate as an asset class really come into its own in the last couple of years, and something you've seen in corporate credit, just putting real estate aside for a minute, in small to medium-sized enterprises, and what's filled the vacuum of traditional bank lending over the last couple of years. You've seen some very legitimate finance platforms that have filled that gap.
And you would see that continuing for the next couple of years.
I don't see why it wouldn't. I think the two ingredients that it takes to have that be a secular, not a cyclical phenomenon are, one, cost of capital. So as a private capital provider, can you deliver low enough cost of capital that you can compete with insured deposits? And we are not running a banking institution. We don't take insured deposits. If we screw up, the Fed will not hold an emergency weekend meeting to bail us out. Our investors are very large, sophisticated institutions who understand the risks that they're taking and who expect us to focus on risk management as our primary goal. And because of that, and we're not alone, I think you've seen this cycle a much broader palette emerge in terms of cost of capital for private capital providers, particularly a lower cost palette. So that's one big thing that is a secular, I would argue, a secular phenomenon, not cyclical. And the second thing is an infrastructure, a platform. In other words, it's not two gals in a Bloomberg sitting in an office somewhere. It's a legitimate front end, customer-driven, customer-centric credit franchise that, yes, our business cards don't say XYZ Bank on them or ABC Insurance Company, but our capital is substantial and our money is green, and we think of ourselves as being in a customer-centric business. And I think, and again, we're not the only one. So this meeting we just had that I referenced a few minutes ago, I don't think that borrower qualitatively views us as being somehow less legitimate than the bank down the street, and hopefully in some ways views us as being much more responsive and much more flexible. So if you see, and this is not just a real estate phenomenon, in commercial credit generally, and actually in residential credit too, it's a little harder to do in consumer credit because the ticket sizes are so much smaller, but in commercial credit, not just real estate, businesses that have competitive cost of capital with insured depository institutions and businesses that have made the infrastructure investment in a franchise, I don't think there's any reason to suspect that couldn't persist across more than just a cycle.